200 banks. That's how many U.S. financial institutions are currently on the FDIC's secret problem bank list. Not publicly named, not disclosed to depositors, quietly monitored while regulators hope nobody notices. But here's what should keep you awake at night. Internal stress test documents obtained through Freedom of Information requests reveal something far more disturbing. These banks aren't just struggling, they're actively preparing contingency plans for collapse scenarios, liquidity emergency protocols, deposit freeze procedures, asset fire sale frameworks. And if you think your bank is definitely safe, I need you to understand something critical right now. 3 of the largest bank failures in American history happened in 2023. Silicon Valley Bank, Signature Bank, First Republic. Combined assets of over $550 billion. Collapsed in days, not months. Days. The banking system is far more fragile than anyone wants to admit. And the internal documents prove that bankers themselves know it. This isn't conspiracy theory. This is FDIC quarterly reports. This is Federal Reserve stress test data. This is SEC filings and internal memos obtained through legal document requests. All verifiable. All public record if you know where to look. By the end of this video, you'll understand exactly why hundreds of banks are preparing for the worst, what the internal documents reveal about their true financial condition, and most importantly, whether your money is actually safe. Because there's a pattern here, a pattern that preceded every major banking crisis in history. Same warning signs, same internal preparations, same public denials until the day the doors don't open. Stick with me, because what I'm about to show you could determine whether you protect your savings or lose them overnight. Let me give you the raw data. According to the FDIC's latest quarterly banking profile, 63 banks are officially on the problem bank list as of public disclosure. But industry analysts examining detailed call reports estimate the true number of distressed institutions exceeds 200. Total unrealized losses in the U.S. banking system currently exceed $500 billion, according to FDIC data. That is losses on bonds and securities that banks have not yet acknowledged because accounting rules let them hide the damage until they're forced to sell. The Federal Reserve's own stress test results show that in a severe recession scenario, major banks would experience combined losses exceeding $685 billion. That's not a prediction. That's the Fed's own internal modeling. Now, I know some of you are thinking, where's this information coming from? Every figure comes from official regulatory filings. FDIC reports, Federal Reserve stress tests, SEC disclosures, bank call reports that are public but buried in databases most people never access. All linked in the description. Verify them yourself. But here's what the regulators won't tell you directly. The internal preparation documents reveal that bank executives know the system is fragile. They're planning for scenarios they publicly deny are possible. Let me show you the banking crisis preparation pattern. This is the exact sequence of internal behaviors that precedes every major banking collapse. Stage 1, hidden deterioration. Asset quality declines, but accounting rules mask the damage. Unrealized losses accumulate on balance sheets. Management knows but doesn't disclose the severity. Public statements remain optimistic. This stage can last years. Stage 2, quiet preparation. Internal documents begin addressing worst-case scenarios. Emergency liquidity plans are drafted. Deposit concentration analysis intensifies. Executives start diversifying personal holdings. Legal teams prepare regulatory response frameworks. None of this is disclosed publicly. Stage 3, regulatory coordination. Banks begin private conversations with FDIC and Federal Reserve about contingencies. Resolution planning accelerates. Potential acquirers are quietly identified. The regulators know which institutions are at risk, but maintain public silence to prevent runs. Stage 4, the trigger event. Something breaks confidence. A bad earnings report, a credit rating downgrade, a social media rumor that spreads faster than PR can contain it. Deposits flee, liquidity evaporates. Within hours or days, a bank that seemed stable becomes insolvent. This pattern has repeated identically in every banking crisis for the past 100 years. The only variable is timing. Now let me prove this pattern with 3 historical examples. 3 banking crises, same preparation stages, same public denials, same sudden collapses. 1930s America, the Great Depression banking crisis, the worst banking collapse in U.S. history. Throughout the 1920s, American banks seemed invincible. Over 25,000 banks operated across the country. Deposits grew every year. Credit flowed freely. The American banking system was considered the strongest in the world. But underneath the prosperity, hidden deterioration was spreading. Banks had made risky loans against inflated stock prices. Real estate speculation had created vulnerable loan portfolios. Agricultural banks in rural areas were already failing quietly. Over 600 banks collapsed between 1921 and 1929 before the crash. Nobody paid attention because they were small and rural. Stage 1 complete. Internal bank documents from this era, preserved in Federal Reserve archives, show that major bank executives were concerned about systemic risk by 1928. Correspondence between bankers discussed liquidity concerns. Some institutions quietly reduced loan exposure. J.P. Morgan partners personally reduced stock holdings while publicly encouraging others to buy. Stage 2 verified. By early 1930, regulators knew the system was fragile. The Federal Reserve held private meetings with major banks about contingency planning. The Reconstruction Finance Corporation was being conceptualized to handle failures. But publicly, officials insisted the banking system was sound. President Hoover declared prosperity was just around the corner. Stage 3 documented. March 1933, the trigger. After 3 years of cascading failures, over 9,000 banks had collapsed. A full banking panic erupted. President Roosevelt declared a national bank holiday. Every bank in America closed for a week. When they reopened, thousands never opened again. Depositors lost over $1.3 billion, equivalent to tens of billions today. The internal preparations didn't prevent collapse. They just revealed that insiders knew what was coming while the public remained oblivious. Stage 4 complete. 1980 savings and loan crisis, the largest banking scandal in American history until 2008. Throughout the 1970s and early 1980s, savings and loan institutions grew rapidly. Deregulation allowed them to make riskier investments. Commercial real estate, junk bonds, speculative ventures far beyond traditional mortgages. By 1985, hidden deterioration was systemic. Over a third of all S&Ls were insolvent on a mark-to-market basis. But accounting rules allowed them to value assets at original purchase price, hiding billions in losses. The industry looked healthy on paper while rotting from within. Stage 1 complete. Internal documents subpoenaed during later investigations revealed extensive preparation for collapse scenarios. Lincoln savings executives discussed how to delay regulatory intervention. Memos outlined strategies for hiding losses through complex transactions. Some S&L executives were transferring personal assets to family members and offshore accounts. They knew what was coming. Stage 2 verified. Regulators were intimately aware of the problems. The Federal Home Loan Bank Board had identified hundreds of troubled institutions by 1986. Private meetings between regulators and industry executives discussed resolution strategies. Political pressure delayed action because closing banks would reveal the scale of the crisis. Congress was lobbied to weaken oversight. Stage 3 documented. When the crisis finally exploded publicly between 1986 and 1995, over 1,000 S&Ls failed. Taxpayers paid $132 billion for the bailout, equivalent to over $300 billion today. Executives, who had prepared quietly, went to minimum security prisons or escaped prosecution entirely. Depositors who trusted public statements lost savings. The preparation documents proved that insiders knew years before the public. They protected themselves while maintaining public confidence until they couldn't. Stage 4 complete. 2008 financial crisis, the banking collapse that nearly destroyed the global economy. Throughout the 2000s, American banks were printing money. Mortgage lending exploded. Complex securities generated massive profits. Banks leveraged 30 to 1, meaning they borrowed $30 for every $1 of actual capital. Wall Street bonuses reached record levels. The system seemed unstoppable, but hidden deterioration was endemic. Subprime mortgages were defaulting at accelerating rates by 2006. Banks held trillions in mortgage-backed securities they couldn't accurately value. Internal risk models were flashing warnings that executives ignored because profits were too good. Stage 1 complete. Internal documents released during congressional investigations revealed shocking preparation behaviors. Goldman Sachs executives emailed about mortgage securities they were selling to clients as garbage, while simultaneously betting against them. Lehman Brothers executives discussed hiding leverage through accounting tricks. Bank of America internal memos questioned the quality of countrywide mortgages months before acquiring them anyway. Citigroup risk officers warned about exposure, but were overruled. Stage 2 verified. By early 2008, regulators knew the system was cracking. The Federal Reserve held emergency meetings. Treasury Department officials were drafting bailout frameworks. Bear Stearns was quietly monitored for months before its March 28 collapse. The FDIC was preparing for mass failures while publicly insisting the system was resilient. Stage 3 documented. September 2008. Lehman Brothers filed the largest bankruptcy in American history. $639 billion in assets gone overnight. Credit markets froze globally. The stock market crashed 50%. The government executed the largest bailout in history. Over $700 billion in direct support. Trillions more in Federal Reserve interventions. Millions of Americans lost homes, jobs, and retirement savings. The internal preparation documents proved executives and regulators knew the system was fragile. They prepared quietly. They protected themselves. The public absorbed the losses. Stage 4 complete. Now let me show you why 200 banks are in the same preparation pattern right now. Stage 1, hidden deterioration. It's already here and documented. U.S. banks are sitting on over $500 billion in unrealized losses, according to FDIC data. These are losses on Treasury bonds and mortgage securities that declined in value when interest rates spiked. Banks don't have to report these losses unless they sell the assets, so they hold them, pretending the losses don't exist. Commercial real estate loans are deteriorating rapidly. Office building values have collapsed 40% in major cities. Banks hold $2.7 trillion in commercial real estate debt. Delinquencies are rising. Refinancing is nearly impossible at current rates. The losses are coming. They're just not recognized yet. Stage 2. Quiet preparation. The internal documents reveal it's happening. Freedom of Information requests have obtained internal FDIC communications discussing specific troubled institutions. Names are redacted, but the patterns are clear. Banks are updating living wills. Resolution plans are being refined. Liquidity contingency frameworks are being tested. Executive compensation structures at regional banks have shifted toward immediate cash payouts rather than long-term stock awards. When executives prefer cash today over stock tomorrow, they're signaling concerns about their own institutions. Insider selling at regional banks has accelerated. SEC filings show executives at troubled institutions reducing personal holdings. They're not buying, they're selling, just like they did before the S&L crisis, just like they did before 2008. Stage 3, regulatory coordination. It's already underway. The FDIC has quietly increased its staffing by 15% over the past year. Resolution specialists are being hired. Bank examination teams are expanding. They're not hiring for routine operations. They're hiring for crisis management. The Federal Reserve's Bank Term Funding Program, created after the 2023 bank failures, allows banks to borrow against underwater securities at face value rather than market value. This is explicit acknowledgement that banks cannot survive if forced to recognize their actual losses. The program is essentially keeping zombie banks alive. The FDIC's Deposit Insurance Fund currently holds $119 billion. Total insured deposits exceed $10 trillion. That's enough to cover roughly 1% of insured deposits in a systemic crisis. Regulators know this math. Internal documents show they're modeling scenarios that would require massive taxpayer intervention. Stage 4 hasn't arrived yet, but the preparation pattern is identical to 1929, 1985, and 2007. The warning signs are everywhere. Silicon Valley Bank collapsed in 48 hours. Signature Bank collapsed in days. First Republic held on for weeks with government support before failing. These weren't small rural banks. These were major institutions with billions in assets. And the FDIC's own quarterly report admits that hundreds of other banks face similar vulnerabilities: hidden losses, concentrated deposits, duration mismatches between assets and liabilities. The pattern is complete through stage 3. We're waiting for the trigger. Now I know what you're thinking, but my deposits are FDIC insured. I'm protected up to $250,000. Let me tell you what FDIC insurance actually means. In a contained failure of one or two banks, yes, your insured deposits are protected. The FDIC has successfully managed individual bank failures for decades. But in a systemic crisis involving dozens or hundreds of banks simultaneously, the insurance fund is insufficient. $119 billion cannot cover $10 trillion insured deposits. The FDIC would require Treasury intervention, congressional appropriation, taxpayer bailouts. This takes time. During the 2008 crisis, even protected depositors faced delays and uncertainty, and deposits above $250,000 are not insured at all. When Silicon Valley Bank failed, companies with millions in deposits faced total loss until emergency intervention. But the government will always bail out the banks. The government bailed out banks in 2008 while letting millions of homeowners lose everything. The pattern is clear. Institutions get rescued. Individuals absorb losses through inflation, taxation, and wealth destruction. Bailouts don't prevent pain. They transfer it from bank executives and shareholders to taxpayers and savers. Your deposits might eventually be made whole, but the purchasing power of those dollars will be inflated away to pay for the rescue. But 2023's bank failures were contained. The system held. 3 banks with $550 billion in combined assets failed within weeks. The Federal Reserve created an emergency lending facility overnight. The Treasury issued emergency guarantees. The response was unprecedented precisely because regulators feared contagion. The system held because of massive intervention, not because it was stable. The next trigger might require even larger intervention, or it might exceed the system's capacity to respond. So what do you actually do with this information? First, understand FDIC insurance limits precisely. $250,000 per depositor, per institution, per ownership category. If you have more than $250,000 in cash, spread it across multiple unrelated banks, not branches, different institutions entirely. Second, research your bank's financial health. Every bank files quarterly call reports with the FDIC. These documents reveal capital ratios, unrealized losses, deposit concentrations, and commercial real estate exposure. The data is public. Use it. Bank rate, deposit accounts, and the FDIC's own bank find tool can help assess institutional health. Third, consider banking with two big-to-fail institutions for essential operating cash: JP Morgan, Bank of America, Wells Fargo. These banks have problems, but they're guaranteed government support in a crisis. Smaller regional banks don't have the same implicit guarantee. Fourth, maintain some cash outside the banking system entirely. Physical cash has counterparty risk from inflation, but no counterparty risk from bank failure. A reasonable cash reserve at home provides options during banking disruptions. When Cyprus banks closed in 2013, only people with physical cash could transact. Fifth, diversify into assets outside the banking system. Treasury bonds held directly at Treasury Direct. Gov are obligations of the U.S. government, not a bank. Physical gold and silver have no counterparty risk. Real assets exist regardless of financial system disruptions. Sixth, watch the warning signs: sudden executive departures, accelerating insider selling, credit rating downgrades, unusual deposit outflows, social media rumors that gain traction. When confidence cracks, it happens fast. 48 hours took down Silicon Valley Bank. Seventh, stay informed. Subscribe to this channel, turn on notifications. When the next bank failure approaches, understanding the pattern gives you time to act before the doors close. Drop a comment below. Tell me what you think. Is your bank on the at-risk list? Have you diversified your deposits? What warning signs are you watching? I read every single comment. Subscribe now, because the next video reveals exactly how to check if your specific bank is vulnerable. I'll walk through the exact metrics that predicted Silicon Valley Bank's failure weeks before it happened. The same metrics you can check for your own institution. The internal documents are clear. Bank executives know the system is fragile. They're preparing for scenarios they won't discuss publicly. They're protecting their own assets while managing your deposits. 200 banks are on preparation protocols right now. The FDIC knows it. The Federal Reserve knows it. Bank executives know it. Now you know it too. The pattern is identical to 1929, to 1985, to 2007. Hidden deterioration, quiet preparation, regulatory coordination. Then a trigger that turns preparation into crisis. We're somewhere in stage 3. The trigger could come tomorrow or in 2 years, but it's coming. The math guarantees it. The only question is whether you'll be positioned correctly when it arrives, whether your deposits are diversified, whether you understand the risks, whether you're watching the warning signs. The information is here, the pattern is proven, the choice is yours. Thanks for watching. This is Finance Reborn, and your financial awakening starts now.